USDC is a crypto token designed to stay worth $1. But it is not a digital banknote, and a blockchain does not magically force its price to equal $1. The system works because a company promises redemption and holds reserve assets behind the tokens. If confidence in that promise weakens, USDC can trade below $1. So, what exactly are you holding when USDC appears in your wallet? USDC is a stablecoin issued by Circle through regulated affiliates. A stablecoin is a crypto asset designed to track something outside crypto. In this case, the target is the US dollar. One USDC is intended to represent $1 of redeemable value. This makes USDC very different from Bitcoin. Bitcoin has no company promising to redeem each coin for money in a bank account. Its price is set by supply and demand. Ether works differently too. It is the native asset used to pay for computation on Ethereum, and its dollar price can move dramatically. USDC tries to remove that price movement while keeping some useful properties of blockchain tokens. It can be stored in a self-custody wallet, sent to another blockchain address, used inside smart contracts, and transferred outside normal banking hours. The basic model is easier to understand if we follow the dollars. Imagine an eligible business sends $1 million to Circle and requests USDC. Once the funds arrive and the required checks are complete, Circle issues, or mints, 1 million USDC on a supported blockchain. The business receives the tokens, and Circle holds an equivalent value of reserve assets for the USDC in circulation. Those reserves are not supposed to be speculative crypto bets. Circle says USDC reserves are held in highly liquid dollar-denominated assets. They include cash at regulated financial institutions and assets such as short-dated U.S. Treasury securities and overnight Treasury repurchase agreements. Much of the reserve is managed through the Circle Reserve Fund, a government money market fund managed by BlackRock. Circle also publishes reserve information, and independent accountants regularly examine whether the reported reserve assets meet or exceed the value of USDC in circulation. That is useful transparency, but an examination is not the same thing as the government guaranteeing every token. It checks specific claims using an established process. It does not eliminate operational, legal, banking, or market risk. Now reverse the flow. An eligible customer sends 1 million USDC back for redemption. The USDC is removed from circulation, usually described as burning the tokens, and the corresponding dollars are sent through the banking system. Afterward, there should be 1 million fewer USDC and $1 million less in the reserve. Minting expands the supply when dollars enter. Burning reduces it when dollars leave. That connection is the foundation of the peg. If you like explanations that show what is actually moving behind the app, subscribe. That is what this channel is built for. Here is an important detail. Most ordinary users are not constantly minting and redeeming USDC directly with Circle. They obtain it through an exchange, wallet service, payment company, or decentralized trading protocol. That creates two different prices to understand. There is the issuer's redemption value, subject to eligibility, compliance, fees, and applicable terms. Then there is the market price available right now on a particular exchange or blockchain. Normally, competition keeps those prices close together. Suppose USDC trades for 99 cents. Traders with access to efficient redemption may buy discounted USDC and redeem it for $1. Their buying can push the market price upward. If USDC trades above $1, eligible participants may mint new USDC and sell it, increasing supply and pushing the price downward. This process is called arbitrage. It is an economic incentive, not a force field. Arbitrage works best when people trust the reserves. Redemption is available, banking connections are working, and markets have enough liquidity. If one of those conditions fails, the market price can move away from $1. That happened during the US banking turmoil in March 2023. Circle disclosed that part of the USDC reserve was held at Silicon Valley Bank when the bank was closed. Uncertainty about access to those funds caused USDC to trade below its target on some markets. US authorities later acted to protect the bank's depositors. The reserve funds became available, and the peg recovered. The lesson is not simply that USDC recovered. The lesson is that a reserve-backed stablecoin still depends on real-world institutions. A token may move on a blockchain every minute of the day, while some of its backing sits inside financial systems with business hours, counterparties, and legal procedures. Now, let's follow a normal USDC payment from beginning to end. Alice wants to send 100 USDC to Bob. She enters Bob's address in her wallet and confirms the transaction. Her wallet creates a message specifying the blockchain, the USDC token contract, Bob's address, and the amount. Alice signs that message with her private key. Her private key does not leave the wallet. The signature proves that the holder of Alice's key authorized the request. The blockchain's validators process the transaction, and the USDC smart contract updates its records. Alice's token balance falls by 100, and Bob's rises by 100. No physical dollar travels from Alice's bank to Bob's bank during that on-chain transfer. Circle does not move a specific treasury bill from an Alice box into a Bob box. The blockchain records a change in who controls 100 units of the circulating token supply. The pooled reserves continue backing that overall supply. Alice must also pay the network's transaction fee. Depending on the blockchain and wallet design, that fee may require the network's native asset, such as ETH on Ethereum. Some applications hide or sponsor this step, but the blockchain still needs a fee mechanism. Once confirmed, the transfer is generally irreversible. If Alice used the wrong address or the wrong blockchain, there may be no bank-style chargeback. Bob can keep the USDC, send it elsewhere, use it in an application, trade it, or cash out through a service available to him. This helps explain why people use USDC. A business can settle with an overseas contractor without both parties using the same bank. A crypto exchange can use it as a dollar-like trading unit. A decentralized lending application can accept it as collateral. A merchant can receive a token that is easier to price than a volatile crypto asset. But saying USDC is a digital dollar can hide some major differences from bank money. Money in a US checking account is generally a liability of the bank. Eligible deposits at an FDIC-insured institution may receive deposit insurance within the applicable rules and limits. USDC is a crypto asset issued by a non-bank company, and the token itself is not an FDIC-insured deposit. Bank payments also operate through systems with account recovery processes, identity checks, fraud procedures, and sometimes reversal rights. A self-custody USDC transfer works more like handing over a digitally signed bearer asset. Control depends heavily on the private key. USDC is not completely decentralized either. Public blockchains may process its transactions, but Circle controls issuance and redemption. Its smart contracts include administrative powers. Circle can block transfers involving certain addresses when required by law or under its policies. That can help enforce sanctions or respond to illegal activity, but it also creates censorship and issuer control risks that do not exist in the same form with Bitcoin. The phrase regulated stablecoin needs similar care. Regulation can impose licensing, reserve, compliance, and reporting requirements. It does not mean risk-free, government-issued, or government-guaranteed. USDC is not a central bank digital currency, and Circle is not the Federal Reserve. USDC also differs from other stablecoin designs. Some fiat-backed stablecoins use a broadly similar model, but have different issuers, reserve compositions, legal structures, banking partners, disclosure practices, and redemption rules. Two tokens targeting $1 can therefore carry different risks. Crypto-collateralized stablecoins use assets locked in smart contracts instead of relying entirely on cash and treasury reserves held by a company. They often require extra collateral because crypto prices can fall quickly. If the collateral loses too much value, positions may be liquidated. Algorithmic stablecoins may rely more heavily on trading incentives, supply adjustments, or a second token. Without enough credible collateral and redemption capacity, those mechanisms can enter a destructive loop when confidence disappears. Even with USDC, the network label matters. Native USDC on Ethereum is not literally the same token contract as native USDC on Solana. Circle coordinates issuance across supported networks, so the total supply remains backed, and its cross-chain systems can burn USDC on one network and mint it on another. But not everything called USDC is native USDC. A bridge may lock genuine USDC on one chain and issue a wrapped representation somewhere else. Now, the user depends on the bridge, its smart contracts, its operators, and whatever assets remain locked. If the bridge fails, the wrapped token can lose its connection to native USDC, even if Circle's reserves are fine. The same layering problem appears with exchanges and lending platforms. If an exchange displays a balance of 500 USDC, you may have a claim against the exchange, rather than direct control of tokens at your own address. If the platform freezes withdrawals or becomes insolvent, healthy USDC reserves do not automatically solve your platform problem. So the main risks live at several layers. The reserves must remain safe and liquid. Circle must continue operating and honoring eligible redemptions. Banking partners and payment rails must function. The chosen blockchain and token contract must work. Any bridge or application must be secure. Finally, the user must protect private keys and choose the correct address and network. USDC matters because it connects two very different systems. On one side are banks, treasury markets, identity checks, and legal agreements. On the other are wallets, smart contracts, public ledgers, and around-the-clock settlement. That connection can make digital payments and on-chain applications more practical. It also means USDC inherits risks from both worlds. The clearest way to think about it is this. USDC is a transferable blockchain token, backed by a centralized reserve and redemption system. It aims to behave like $1, but it is not identical to $1 in a bank account. Its stability comes from assets, rules, market incentives, and trust in the institutions connecting them. If there is another stablecoin, wallet, or crypto mechanism you want explained without the hype, leave it in the comments.